Hey everyone, welcome back to Lunch of the Market. So the market is in a precarious situation. It's gone up and up and up and up without any real pullback at all. So the prudent thing we think to do is to take money off the table and to start to take the other side. Now, in getting these names, we have to thank Jim Cramer, who did a show last night about stocks going parabolic. So a parabola is basically a U shape, and once you get to the other side of the U, stocks have the angle of ascent is just unsustainable. It's too much. At some point there's going to be a pullback. People are going to take money off the table, and we think it's going to be between now and when earnings start the second week of April. That's a long time to sit around and hold on to your winners and to not take the other side of the trade. If stocks are going to go down, then we want to benefit from that because it will help our overall performance over the course of the year. What stocks are candidates to bet against their continued rise? Well, those stocks that have gone up the most. And so what we did was, thank you Jim Cramer, we paused the TV when he showed us his list of ticker symbols. We've seen those lists before. We keep lists next to the desk as we watch CNBC and as we do our research. We keep ticker symbols so that when the market gives us the entry point that we want, we can quickly bring those ticker symbols out and then go shopping. We've already done the homework ahead of time. So we took those, we went through the charts, and we called out Colgate, ticker symbol CL, Monsanto, ticker symbol MON, McDonald's, ticker symbol MCD, Newell Rubbermaid, NWL, Cerner, CERN, and Covidian, COV. So those are the stocks that we see, that charts that basically had parabolas, and they were at risk of coming back down the other side now that they've basically completed a U shape. So with all that risk in the market, the market is barely holding on. Dow's only up 22, S&P's barely negative, and the NASDAQ is barely positive. We think that as the stock market runs out of steam, people are going to take their gains off the table and wait to see what earnings look like, especially with Europe making all kinds of rumblings. It doesn't really matter why the stock market sells off. It only matters that it's probably going to. And so for now, we'd rather start accumulating short positions, meaning we want to bet against things. We're going to do it through the trade structure of a put butterfly, a lopsided put butterfly. Remember Trade School 101 real quick. A put butterfly normally has equal wings. Okay, that's why they call it a butterfly. Say $5 and $5. You're long a put spread and short a put spread. But the problem is if the stock trades all the way through all your strikes, then you're basically left up with a trade structure that is worth nothing, and you paid to put it on, which means that you're going to lose the money that you paid, and it's not going to benefit you all. So it acts as no kind of hedge in a market downturn, okay, especially if the goal is to make money on the downside. So what we've done is we've made the long strike bigger than the short strike, hence the lopsided put butterfly, which allows us to stay in the trade even if the stock blows all the way through all our strikes. Okay, ideally what happens is the stock gets pinned at the strike that you're short, and then that's where you make the most money. What we've done is we've leveraged the trade structure by setting up trades in which you can make double, triple, quadruple, or even quintuple in some cases what your initial investment is, with only risking your initial investment. That's the key. Okay, if you just sell put spreads or sell call spreads, you could lose a whole lot more than you take in. Say you take in a buck for a $5 wide call spread. Well, you could lose $4 on top of that. Okay, so it's skewed in terms of risk reward. What we want to do is, limit our loss to just the long side, and then use selling the short put spread below it to reduce the cost of the trade. Net, we're still only out. The worst case scenario is we lose what we paid to put on the trade. So in Colgate, CL, we like the May 110, 95, 90 bear put spread. In Monsanto, we like the 100, 90, 87 and a half lopsided put butterfly in July. Okay, so get out your pencil in case you haven't already done so. Just write down the three numbers. In June, we like the McDonald's June 97 and a half, 87 and a half, 85. So just to reiterate how you put this on, you buy the 97 and a half put, you sell 2 of the 87 and a half puts, and you buy 1 of the 85 strike put. 97 and a half, 87 and a half, 85. Okay, if it gets pinned to 87 and a half, your trade's worth that full 10 bucks. Okay, if it goes below that or stays above that, okay, then you subtract that from your 10 bucks. Worst case scenario, if it goes all the way through below 85, is $9.75. So as long as you can put $9, sorry, the worst case scenario is $7.50. So as you put this trade on, make sure that you don't pay that amount. As long as you don't pay that amount, what the trade is worth if it goes all the way through, and you think that the trade's going to go in your favor, then it makes sense to put it on. Okay, last three. Cerner, June 90, 80, 75, put butterfly. Covidian, COV, July 65, 57 and a half, 55. And then outright puts in Newell, NWL. Those are at the 25 strike because there's the options market for those Newell 25 puts, and they're either June or July. It's telling you that the stock's not going to do anything but go up. There's no premium in any of those lower strikes, so it didn't make sense to cap our gains, or possibly cap our gains by selling strikes against it when it just made sense to outright own the puts. You're only going to save maybe 20, 30, 40 cents, if that, by selling the two puts at a lower strike. And so it just made sense. You pay like $1 and you get the 25 strike put, which is right where the stock is trading at. And again, these stocks have all gone parabolic. They've all run huge. And I know it's really hard to take the other side of a big winner, but the reality is when the market starts to roll over, those are the stocks that are going to get sold first. I guess in the floor language, it would be like this, right? You push it out instead of bringing it in. Okay, so as those stocks come in, we think those are the names that get sold off first. So that's why we like that. We also like that they're on Jim Cramer's list. And so what we're going to do is on our Facebook page, go find the Magnum Opus Financial Facebook page, and we're going to we're going to put the pictures that we took and give you the whole list, so you can find your own names that you want to short. We'll give you several pictures that show you the whole list from Mad Money, and you can go search those lists. We paused the television. Thank you, Jim Cramer. So you can look through that whole list of charts that have gone parabolic. Okay, and you can decide for yourself. You can either take our trades in CL, MON, MCD, NWL, CERN, or COV, or you can come up with your own. But we think that at the end of the day, you want to take more stock off the table right now than add to it, because the markets look like they're getting ready to go the other way. Thanks for joining us at Lunch of the Market, and we'll see you again soon.